Good morning and welcome to the Monday call brought to you by NZ Funds. I'm Stefan Clark, Chief Client Officer, and to my right, I've got Mark Brooks, Chief
Mhm.
Investment Officer, and further along, James Gregor, Investment Strategist. Welcome for joining us, guys. This morning, we're going to be kicking off our second attempt at this conversation. NZ Funds has been putting a lot of energy into what it calls its knowledge series, which is a series of papers, white papers on how we think about portfolio construction and how we validate the ideas that underpin the way we build our portfolios for clients. And two topics that are dear to our heart are downside mitigation and equal weighting of the portfolio construction process. So, without further ado, we're going to kick off with downside mitigation. Tell Mark, if you wouldn't mind starting,
Yep.
tell me a little bit about what the idea is behind downside mitigation and the use of Universa, and what our, I guess, academic review of this methodology has led to in your thinking.
Cool, cool. I'm not sure they're dear to our heart. That's taking things a little too far. But I think, one of the big challenges in life, but also in financial markets, is people kind of take things for granted. They sort of assume something is true and they just move on. But we want to sort of always, with the investments and the construction of portfolios, is kind of ask that question why, and make sure that we know why. So the this white paper series and looking at sort of different assets and how they and how we construct portfolios is really, that's the heart of that question. Sort of asking why to start with, and seeing if the results we get correspond with what we expect, and actually whether it needs to change in the portfolios. So I suppose, with that sort of setup, if we look at Universa and downside mitigation, is that um, ultimately, we know from academic research that diversification is kind of the only free lunch in investment markets, and from that point of view, it's particularly powerful in driving, well, certainly letting you achieve a level of return that would be less risky than holding a smaller group of assets. But the challenge is when you get extreme moves, a lot of correlations move to one, and that diversification doesn't pay benefits. In fact, it can actually be a negative rather than helpful. So traditional hedges, things like gold or bonds and things like that, might don't really provide the protection that you want it to. So ultimately, the next step is looking at tail risk hedges, which is what Universa does, and really there they aim to help to mitigate really extreme events, such as a 20%, a sharp 20% downside in the S&P, and to provide a use the technical term, but non-linear payoff, sort of explode in value as markets have a very sharp move down, and have that ultimately bring in some of that diversification factor that doesn't come from more normal assets. Um, Anything you wanted to add there, James, that I haven't, probably plenty I haven't touched on?
Uh, I think the thing that excites me the most, it is dear to my heart, but I'm also, we're all wearing white shirts, so we look
You
smart.
are an investment geek.
Yeah. But the thing that I think that is often missed with downside mitigation, sort of tail risk managers, is it's important in terms of what it can do on the downside in a sharp downturn. But I think where it really creates a lot of value for portfolios is it enables you to stay invested when things might be volatile or uncertain, but you can still stay fully invested. And usually those are the times like now where people are nervous, but because you have this known sort of safety net, being fully invested throughout 2025 has been an outstanding outcome for investors. And you're able to do that and not worry too much if there's a sharp downturn because of some sort of Trump speech or political announcement, because you know you've got that protection if you need it. Whereas at times people perhaps or when I say people, other managers may take risk off the table in order to combat that. And when you're 80% invested and markets are going up, that's when investors really lose out. So I think that's the part that's often forgotten. It's the being able to get the upside as well as protect the downside.
Yeah. So ultimately, yeah, if you look back through time, right, is it's about being invested in the asset class over time, and it's yeah, so often there's that not incentive, but that nagging question: should I be here now, given X or whatever? And it lets you do that, which is really powerful.
This is a question I have for you, Mark. That was is an unfair one because your background is in bonds and investing in bonds over the last, what, is it 35 years? Sorry,
Yeah.
but which is it. Do these sorts of strategies replace bonds? Are bonds no longer needed as a portfolio diversifier, or is this as well as how do we think about it in that context?
Well, look, I think one of the key parts is, yeah, eh, along with a lot of our strategies, Universa is mostly unfunded. So it actually lets you be invested in broadly 100% equities or even slightly over invested in, levered into equities, which gives you that ability. Whereas if you're, especially a traditional bond portfolio, will take cash. So, you're taking out of a high returning asset to look to put your to put out money into your defensive assets. So short, eh, I didn't think we need to be careful. Tail risk strategies are there for extreme events. If we get normal market volatility or a typical 10 to maybe 15% drawdown in share markets that you might see every year, uh, we wouldn't expect tail risk to add. Whereas other diversifiers like gold or bonds can add some diversity in those uh, situations, but not in the bonds work in the extreme event, but not to the same degree.
It's almost like the worst case scenario for a tail risk manager, and therefore why you'd want bonds is like you're saying. It's almost the death by a thousand cuts market of down 20, but over a 2-year period or something horrendous like
Exactly.
that. I don't know
Yeah.
if we've actually had that before.
Well, 22 was kind of like
Yeah,
that.
yeah.
Yeah.
So for listeners who are unfamiliar with the way Universa is set up and how we use it within our portfolios, do you just want to wind back a little bit and just say,
Yeah.
okay, well, where does it exist currently in the portfolios, and what do you see its role in practically? How does it function?
Yeah. Sure. It's in the growth portfolios to start with, so it's only there. And it really, and I think, the analogy I use is that, NZ Funds is an active manager. We do look to position portfolios for the market we see ahead over the next 6, 12 months, 18 months, etc. But every once in a while, you do get events where the market is going north down the road, and 3 or 4 days later or a week later, everything's going south. And in those situations, it's not feasible to react. It's not feasible to predict all of those sort of events. Um, and in order to help cushion, but it won't mitigate, it won't dominate the portfolio, but help cushion the negative share market returns, Universe is there to provide that fillet of value, I suppose. And how do they do that? I suppose at its simplest, um, always hesitant to use this term, but sort of it is almost a negative financial market lottery ticket that they are buying put contracts on the S&P, so we know exactly the market that it's on. Put contracts on the S&P that give them the right to sell the market 20% below the value today. Now, you wouldn't want to do that. And these contracts are very short, 4 weeks, 6 weeks, maybe 8 weeks. So very short horizon. You're unlikely to, um, yeah, the value. And why would you sell something lower than 20% lower than the value today, 20% lower than the value today? So the value of having that contract or buying that option is very small. Yeah, I'll make up a number, but 3, 4, 5 cents in the dollar. But if you get the very sharp move, clearly the value of that contract explodes in value. And during COVID, what we had about 60 basis points, I think, invested with Universa and the growth portfolios, and that exploded to sort of 6 to 7% of the portfolio at its peak. That was about right.
Yeah, something like that. Yeah.
Yeah. So not enough to um, outweigh a 20% plus move down in the share market, but certainly one to provide some capital reinvest back in, which James will probably touch on in that compounding aspect, but really sort of also provide that cushion.
Yeah, I think on that, that's a really good, I guess, segue for me into a lot of this is behavioral.
Yeah.
So when an advisor is talking to their client and saying that the market is down 20%, that's a difficult conversation. But if the portfolios, all things equal, are down 15 round numbers, then that's a positive conversation. And so uh, uh, I guess by design, the client feels better about that and is likely to stay invested. And that's important for two reasons. One, like you're saying, it's the worst time to pull your money out when the market's already down 20%. But then you've got this dry powder to reinvest into a market that's 20% cheaper. And given we're an active manager, we can pick and choose what parts of the market to go into because there might be things that are down for a reason. During the tariffs in April, there were some sectors that you didn't want to be in.
Yeah.
They were affected and still are, but there are other sectors. I'm not sure the exact numbers for, say, the New Zealand market, but if I always use if Meridian Energy and Contact Energy are down because of Trump tariffs, then you want to be buying them. And it's that sort of mentality, and that dry powder can give you it, and that then gives you that sort of, I guess, compounding for as the market recovers back to where it was.
Yeah. And I think that behavioral aspect is even useful for us, right? So tariffs are a good example. Market got broadly close to 20% down over that, not quite. At that point, looking back through time, we felt that the vast bulk of the negative news was priced in. So, we had we felt it was the right time to move back in and become fully invested. But in the back of the mind, we also had, I suppose, the backstop's too strong a word, but the confidence that if markets got significantly worse, we were getting close to the point where um, the Universa contracts were starting to increase in value pretty sharply and would continue to increase in value to help mitigate the portfolio.
So, you in the white paper that was prepared, what did the research show from that? Was there a surprise, and was it a surprise from what you were expecting, or was it in line with how I guess the back testing from your views is what it would look like in the real world?
Yeah, I think there's two aspects to touch on there, and they are sort of linked in that, yeah, we've talked before about the value of actually having running a degree of leverage in terms of portfolios so that share markets move up over time. So if you can own more than 100%, it gives you, you know, over the long term, a better outcome. But clearly that comes with more volatility and more, um, when you get negative events, probably larger drawdowns. On the flip side, there is a cost to Universo. So if you are just 100% invested and you use Universa, that does suggest in normal years you will be slightly less than the market because there is for want of a better word, an insurance cost. So when we sort of ultimately looked at putting the two together, and the nice thing was that, yeah, putting the two together meant that you had very similar experiences in terms of volatility, uh, very similar experiences in terms of drawdown as you stepped up. But we looked at, originally 100% MSCI World with no Universa, and then moving up to 110% MSCI World, all the way to 130% MSCI World, and 10, 20, 30% Universa. Um, Ultimately, you managed to you broadly kept your volatility similar. But the real kicker was you get that during those negative events, you get to reinvest that capital, and that boosts the compound return materially.
And some people believe that, like, in markets, that I guess the left tail risk is much larger than it's priced for. Is that part of the thinking and how you use the contract, or is it more that it's centered around the behavioral piece?
Well, look, I think, behavioral piece is probably the most important part for us, but certainly, yeah, mo- eh, often many market participants are short term in their nature, and especially over the horizon of the sort of contracts that Universa purchase. Uh, the assumption is that yeah, the probability of a really ugly outcome is very, very low. It's a normal bell curve for those who like the maths. Whereas, we know that over time financial markets have what are called fat tails. So negative, very large outcomes, very large positive outcomes, and larger negative outcomes are more likely than a normal statistical probability. So actually, in many respects, over time, the ability to buy these options, they're underpriced relative to where they should be. So that's from a day to day and management point of view, it's really about having that cushion.
Okay. Do you see, I guess, the use of tail strategies or tail risk strategies in New Zealand? It's not that common, is it? So it's something quite unique for NZ funds in the retail space. And um, do you see it in other areas within, I guess, Australasia much, or is it more common overseas?
Well, we have an exclusive contract with Universa here in New Zealand, so nobody else can use that product. So it's truly unique from that point of view, and very much a unique, uh, I suppose, selling point or point of difference for New Zealand funds. In terms of other ones, I think the hard bit, and you know, James will better add to this, is that uh, what is nice about Universa is it's on the S&P, and because the S&P is such a big part of people's portfolios, we know there's a very clear relationship. If you get a drawdown in the S&P, the Universa allocation will, respond. Whereas other tail risk strategies have often been on, emerging markets or oil or things like that. And the biggest challenge with those, in my mind, is that you end up with a uncertain outcome given an event.
Yeah, that's a really interesting point. There are other risk managers or left tail risk managers out there. The way that someone described it was, I thought, a really good way in terms of those sorts of managers versus Universa. So Universa, as Mark said, is weighted versus in our case, the S&P 500. You can choose things like the Nasdaq if you want it, and it's correlated to that. And so if markets go down, and that's a big driver of all markets because of the correlation between global markets. The other managers think of it more as a manager goes through a forest and sets lots of traps in different places, at the bottom of trees, at the top of trees, in caves, and those sorts of things. And uh, when the animal, i.e., the drawdown, happens in that particular trap, then you make good money. But the S&P 500 could be up strongly or down strongly. You sort of don't really know when it's going to happen, and so it helps less with that behavioral. Markets are down, I'm worried, I'm nervous. It's more, it just can provide upside at points in time where markets could be up or down. Uh, and I think that that goes to a simple way of who uses it and why do people use it. And I always go back to that fifth form, for those of you that did fifth form maths equation, that if something goes down 50%, you need to go up 100% to get back to where you were. And that's the predominant reason why you have big endowment funds and sovereign wealth funds globally use something like Universa, because they're about maintaining that consistent upward trajectory of their portfolios to pay the liability, whether it's a pension liability, or in New Zealand's case, it will be our pension liability from 2030 or something. And so they don't want to see that deterioration in capital, because then you have to do a lot of work to get back to where you were. And so this smooths it out. And so if instead of going down 50% to go up 100, I'm using round numbers because it's easy maths, but instead, if you went down 30%, then you'd need a whole lot less upside to get back to where you were, and that really provides that stability. So the biggest users of Universa, things like CalPERS, the big
Yeah.
um, endowment fund in the US, but also other sovereign wealth.
Yeah, sovereign wealth funds and things like that. So, we saw that in the numbers in terms of, the back testing. If we looked at, say, the S&P between 2025 and from 2000, uh, average annualized return 6.8%. but including Universa actually gave you a annualized return of up to 8%, so up to 2% better. Now that, times doesn't sound much, but you put that over 25 years, and that can mean taking your total cumulative number from up 300% sort of up basically double that, sort of closer to sort of up 600% or more, depending on the mix. So really that ability to capture that, um, I suppose, one, not have as much of a drawdown, but ultimately have assets as well to reinvest into cheap, low markets.
I find that fascinating. Sometimes when you look at per annum returns, it's you can't get such context, but then you look at cumulative, like, oh, that's why.
Yeah.
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 Compounded over 20 years, and it looks very, very different or 10 years. Yeah. Okay. So I guess to paraphrase, helps manage, I guess, systemic risk and mitigates or dampens or cushions was your word, cushions the drawdown. And that allows us to reinvest um, and then at typically lower prices. And then because we're using it in addition to the portfolio rather than selling a portion to create a diversification benefit, it's in addition to it. Other than the premium, it is actually not detracting from the core underlying drivers of the growth in the portfolio, which are shares and bonds.
Yeah. Yeah. I think another way to put it, which I think might be useful for people, is if we look at the history of Warren Buffett, great investor, and clearly exceptional track record. But one of the bits that people often don't understand is that essentially he has two portfolios that he uses. One is his core portfolio of equities, of shares, and yeah, clearly he's chosen very well over time and is an exceptional investor. But that portfolio is 100% invested in shares all of the time, regardless of markets. What people miss often is that he has another portfolio, which is the asset, the investment pool of the insurance companies that he owns, and typically they're invested in bonds and short-term, low-risk assets. But during difficult periods, he uses that pool of capital to reinvest into shares when they're cheap, when they're down 20, 30%. And when often you see on social media or something, Buffett selling and he's moving to cash. Well, actually, it's that part of the portfolio that he's returning to its core original place. The other part is always 100% invested in shares. So being able to move into shares when they're cheap just has the same impact. It takes his annualized return up so much more because he is buying, essentially becoming leveraged at cheap prices in a market that he knows and is convinced is going up.
It was that the trade of the global financial crisis when you bought Goldman Sachs stock and for uh, cents in the dollar. I forget the exact details, but yeah, it's those sorts of opportunities that he jumps into. And although his annual return is what 12% a year, so that's all you need.
Yeah.
Yeah, that extra couple of percent makes a difference.
It does.
Yeah, it really does. Okay, thanks, guys. So the second topic and another white paper from NZ Funds related to equal weighting versus capitalization-based weighting.
This one's a doozy.
It is a doozy. Yeah, it sounds terribly technical, but break it down. What does it mean, and why is it important?
Cool. Look, again, I come back to that first sort of opening statement. This is, gets into that nuts and bolts of, is the market standard approach the right one? And do we necessarily want to, yeah, or do we want to follow that, or at least ask the question why? And if you think about the normal market, an MSCI World, an S&P 500, even an NZX 50, they are what's called capitalization weighted. So the biggest companies get the largest weight, and that is the standard. But really, it's the question whether, yeah, it's not the only way. And in many respects, what we've looked here is there a benefit to using equal weighted? So instead of the largest companies having the largest weight, each, say, in the case of the NZX 50, if it was equal weighted, each company would have a 2% weight. And they'd all be the same size. So you'd get, 50 times 2 is your 100% weight.
And where did it lead to?
What is interesting, because, what are the inherent biases of capitalization-weighted index is obviously it rewards those who do well. So big companies that are doing well get bigger. And if we looked back, if we look at, I suppose one of the discussions at the moment is something like Nvidia. It's the largest stock in the US, and people are sort of saying, well, the market is very concentrated across very large companies like that. So you do get concentration risk. You definitely get some momentum, whereas ones that are doing well get rewarded. So you get a momentum bias. And by the nature of sort of clumping of those large names, you get, I suppose, a lack of diversification. So, in terms of the equal weighted, that, first of all, tends to, companies that are doing well and getting larger get sold. So, there is some natural profit taking. And then on the flip side, companies that aren't doing as well do get you put buy back into them. Ultimately, I suppose it's a bit of a value strategy from that point of view. You're selling the expensive names and buying the cheaper names, and equally by the nature of being equal weighted, you have much more stable mix of um, sectors and industries, etc.
It was interesting when we had Fisher Investments, our global shares partner, in the office last week. The We've been partnered with them for a number of years now. They're based in California, and one of the biggest discussions I guess we had, Mark, when they came in was around, are we in a bubble? And I think was their answer. In fact, it might have even been your answer. In fact, was, well, if you're all talking about it, it's probably not a bubble, because it means markets are rational. If you're talking about a bubble, you're probably actually looking at some of the fundamentals behind it, and therefore you've probably got to
And by definition, it's getting incorporated into price.
price. Exactly. And then a really good example was one of the big tech companies had a result. It met expectations, but it actually came down in share price, which was healthy because it didn't exceed dramatically, and so it was probably overshot perhaps prior to the result. But what I thought was interesting about that comment is it doesn't mean to say that there's some really high valued, maybe potentially overvalued tech companies in the S&P 500, and being in an equal weighted index gives you a strategy to still be invested, but perhaps just not as influenced by them.
Yeah, yeah, and ultimately that's kind of what we found in terms of the data when we looked at it is actually that um, natural rebalancing that you do when selling those expensive names and buying the cheaper names, the under ones you're underweight, uh, did lead to you know when, uh, basically 80% of the outperformance of the equal weighted versus a capital weight was due to that factor of selling the expensive names and naturally just profit taking profit every 6 months or so and reinvesting it back into cheaper names. So that was really the driver of that sort of return. And in terms of if we looked at sort of the again the S&P 500 over that time frame, sort of 2000 and 2005, it took you from an 8% annualized return to one that was closer to sort of 10%, 9.8%. So it was actually quite a significant difference. It's worth saying, clearly there can be actually quite long periods where the two strategies diverge noticeably, but yeah, the equal weight uh, does have, the data shows that it can be a superior strategy because of that taking profits ultimately.
And then there's things you can do within that as well, isn't there? Like you can be invested. I'm just making up a scenario, but say the S&P 500 equal weighting, and that gives you a smaller tech exposure. But then if you want tech, you add to it with Nasdaq,
Yeah.
and then makes you much more nimble. So if you think the tech's overvalued, you can sell some of the Nasdaq, but you still own the equal weighted S&P 500, and that can be helpful during periods where it has good momentum, but you're a bit worried about tech valuation or something like that. And I know that's something, these divergence in returns being between equal and cap weighted. If I look in Mark's Bloomberg screens and all the things that you look at, I mean, it's something that you're looking at constantly just to make sure that, they're in line and where is their value, I guess.
Yeah. Yeah. And obviously, within the inflation space, that's an area where we've actually really focused the portfolios on equal weighted allocations. So there's, the inflation space is focused on property, infrastructure, and utilities, and then half in Australasia, half global. Each of those six portfolios, they're equal weighted portfolios. And so we sort of tested those along with a number of the major global equities. And what we did find was, and over the sort of last 25 years, is eight of the nine indices we tested, the equal weighted actually outperformed over that period. And the one that didn't, the global real estate, was very much a wash in some respects.
When I first started at NZ Funds emptying rubbish bins, and before the turn of the century, I can say that now. At Telecom, which is now Spark, was something like 30% of the index. And so they came up with a whole different index just for that, because even if you had 20% of your portfolio in telecom, you're still 10% underweight. And so basically the whole market was driven by that one stock.
So the A2 period as well.
Oh, yeah, exactly right. Yeah.
Okay. So, was there a difference in if it's adding value through your utilities and the inflation categories? Did you see something different with how it performed in other markets, or was it basically the same outcome where over different periods, equal weighted often outperformed?
Yeah, look, I think again, it is with that acknowledgement that if we talk about market returns, of course, they're always expressed in a capitalization.
Yeah.
That's the standard. So, uh, relative to market, you can have long periods of very different performance because of equal weighted. And yeah, you go back to a good example would be sort of late 2023, where pretty much you had to own the Mag 7 technology stocks to generate your return. If you owned the other 497 stocks in the S&P, you essentially had zero return. I'm exaggerating, but and if you owned anything else anywhere else in the world, you had zero return. So you get very different outcomes. But what we did find, and again, as I sort of touched on, that sort of the nine different um, indices we looked at, both in New Zealand and um, globally across the sector specific indices, and also across more uh, global indices, S&P, MSCI World, etc. Uh, Over that longer time frame, equal weighted was a superior strategy.
And do you think this is a function part of I guess everyone typically using market cap as the approach? Is it a function of passive investing that's driving that, or is it more just that's a sort of a historical factor that's led us to focusing um, on that as the kind of the primary benchmark?
Look, I think it, probably behind this is an acknowledgement or certainly a belief that markets are mean reverting in terms of which companies dominate, which companies, the valuation of companies. So if you look at one thing we do look at, we spend a lot of time looking backwards and saying, well, where are valuations versus history? And valuations don't keep going up forever. Uh, Valuations over a shorter time frame, and when short, I mean sort of 1, 2, even out to 3 or 5 years, can be a poor predictor of next year's performance. But over longer term, markets do mean revert, and expensive companies become mature, businesses change, and they come back to being normally valued companies. So by the nature, I think if you think about that process, that's why the equal weight works, is because you're naturally selling those more expensive companies and buying the cheaper ones.
To give the cat weighted index a fair go, I think where it does really benefit is as you're going through a change or transition in a sector or technology, it takes that into account. And so uh, you know, Nvidia, I think Mark said it even before, but Nvidia didn't even exist in 2003, and then it was invented in 2004 in a Denny's restaurant in Minnesota, and no one had really ever heard of it. And the only way that people got more and more exposure to it was just because it was part of the cap weighted index became bigger and bigger. And so by design, you were investing in it. But it gets to a point where that gets perhaps a little too much, and it's periods like perhaps now. I'm not saying that
Yeah, I
it's
mean,
overvalued, but
look, I think, we need to be careful. We're not saying we don't want to have cap weighted indices, and certainly a decent amount of the growth portfolios are invested in, predominantly invested in cap weighted indices. But it's just about asking the question. First of all, understanding is another option, and also looking at what has history told us. But yeah, it's a very good point that in terms of cap weighted, one of the benefits is it does have that momentum and it captures those names that are.
It's probably also more reflective of the economic reality, right? If the company's bigger, it's going to be having a bigger, on average, a bigger economic input or output, both really,
I mean,
in the economy. So
Mark showed me a piece of research his team did last week about just forecasts of NVIDIA's cash earnings per quarter. And it's going from, what was it, 30 billion to 60 billion or something like that?
No, 2 years ago, so we're using Q3 numbers here, just the third quarter. 2 years ago, they earned $18 billion in the third quarter. This year, the expectation is 55, so 3 times higher.
In a year.
That was
2 years.
2 years. Yeah.
Oh, we'll forgive them.
EBITDA was also 3 times higher, but cash flow four times higher. And there's an old saying from Peter Lynch that follow the earnings, price will follow earnings, and lo and behold, share price is up 4 times. So, it's a bit of a sideways step, but there is a lot of talk out there about bubbles and things like that. And as you said, we are of the view that because people are talking about it so much, that concern is positive and suggests we're not there. But equally, something like an Nvidia, there may be some questions about some of their investments and some of their earnings revenue recognition. But at the end of the day, they've grown cash flow by 4 times. The share price is up by 4 times. There is nothing irrational or bubble about that at all.
I think it goes to also what active management is these days. It's not just about picking individual stocks, or if you're an active manager, and if you're a passive manager, you buy the index come what may. One, we do both.
Yep.
And then you're there with your team analyzing stocks, absolutely. But you're also saying, actually, we can create better value by, making these changes, which could add quite a lot of value either way, either by being in the cap weighted index or equal weighted over time, depending on where we are in the cycle of different sectors.
Yes, tools in the toolkit, I guess.
Yeah, exactly. And again, to that idea of very large positions in a cap weighted index, Nvidia clearly in the US is that very large name. You touched on telecom. Another one, which was, a massive component for a long time, was if you go back to the 1950s, General Motors was the same size as Nvidia in the S&P 500. It just stayed there for about 20 years. But eventually...
General who?
No. Correct.
Okay, thank you. Is there anything else you wanted to add on market cap, or how implementation, is it tricky to do? Or is it because we're buying contracts with counterparts overseas that for the most part it's not?
Yeah, yes and no is the answer. Like, you can buy, for example, a equal weighted S&P future. So it's not quite as liquid as the normal S&P future, but that is achievable. As you move to other specific sectors, that can become much harder. So often, in terms of the inflation category, we have essentially gone back and built, in a number of cases, built the equal weighted index and built the portfolio from there. Yeah.
You probably did that on AI or something too.
Okay, gentlemen, thank you so much for your time. It's a really good session on a very technical topic, but one that is dear to our hearts. Look forward to talking with you all again in a couple of weeks.
Highly recommend you read the white papers if you're interested, because they're written for a general audience, and so they are relatively consumable. So if you want them, then definitely seek them out.
Brilliant. Thank you, everyone. Thanks for joining.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning or any other matter. Past performance is not an indication of future returns.